Hi everyone, welcome to another MakerDAO collateral call. This is number 29. Today is April the 7th, 2021, at 6 p.m. UTC, and I'm very happy to have Bancor and its team with us. I'm also joined by a bunch of enthusiasts about of Maker, and yeah, happy to have you guys here. Mark, do you want to tell us a bit who you are and your role in Bancor?
Yeah, certainly. So I was a research scientist until the beginning of this year. I joined the Bancor DAO just as a community member with the launch of V2.1 in October last year. And I started collaborating with the team members and the founders on various aspects of the product. Most notably, I was working closely with Eyal Herzog on a flexible credit system that we now call the Bancor Vortex, which has been a long time rolling out, but we've just finished the final stages of everything that we needed to get that off the ground this week, and that should all be coming together pretty soon. So I'm now a full-time consultant with the Bancor Foundation, and I help to analyze and advise on financial and economic problems that the protocol could face going forward.
Nice. And for those in the call that are not or that don't know Bancor 100%, can you describe it in a couple paragraphs?
Of course. Yeah, so Bancor is an automatic market maker. It was actually one of the first market makers on Ethereum. It's gone through several iterations. So the first version of itself was pretty simple, very similar to something like Uniswap or SushiSwap, except that the BNT token takes the place of Ether as the base token across all of the pools. Since then, it's been through two major upgrades. The first was what we called Bancor version 2, and this introduced chain-link oracles and a dynamic weight system to try and address impermanent loss. But it turned out this was not a sustainable way to address the problem. And so Bancor version 2.1 introduced a dynamic token supply as a more elegant way, I think, a more permanent, more sustainable way of addressing the problem of impermanent loss. So unlike automatic market makers like Uniswap, SushiSwap, where you have to provide liquidity with 2 tokens, on Bancor, you can provide liquidity with just 1. And the protocol will provide the other token, BNT, and fulfill the liquidity pair. And so liquidity providers on Bancor have this amazing ability to manage their portfolio essentially in exactly the way that they want to, rather than being forced to sell some of their token to buy Ether to become an LP. And the protocol insures them against this market effect called impermanent loss, which is something that occurs when the price of 2 assets start to deviate. But I talk about, I go into these concepts in detail in the presentation, so I think I'll leave the introduction there.
Sounds good. Yeah, and just a reminder for everyone, if you have any questions, feel free to jump into the mic, and yeah, Mark will be happy to answer them, hopefully.
And also just to introduce myself, sorry to jump in. I'm Nate from Bancor too. Also, so great to be here. And Asaf is joining from our team too. So great to meet you guys.
Great to have you.
Okay, should I share my screen and start the presentation from here?
Totally.
Okay, can you guys let me know if that looks okay?
Yes.
Okay, so okay, yeah. So yeah, I mean, thank you so much for having us. The reason we're having this call, obviously, is because we're interested in getting Bancor as accepted collateral on Maker. And so I've organized this presentation in sort of two ways. The first is going to be sort of an introduction to the Bancor tokenomics and the protocol, how it works. But then I'm going to iterate certain parts of it that I think are explicitly of interest to Maker and should help to justify why Bancor, the BNT token, should be accepted collateral. So I find it helps sometimes in explaining some of these concepts, to personify certain elements of the process. And so I'm going to use characters from the Matt Groening universe, and Bender in this case represents the Bancor protocol. And so Bender has two main powers when it comes to the BNT token itself. And that is, he can create tokens when needed, and he can also burn these tokens when they're no longer needed. And so this makes the BNT token itself an elastic token. It has no fixed supply, but it doesn't just grow, it can also contract during deflationary periods. So we need an elastic supply in order to empower two really important properties of the Bancor protocol. And the first is what we call single-sided liquidity. Single-sided liquidity is what I was talking about in the introduction. This is where a LP, rather than having to provide both sides of the pool themselves, can instead provide liquidity with just the token that they like the most. So we're going to use Tony as an example of someone who is extremely bullish on a particular token. And it feels fitting that since this is a Maker onboarding call, that Tony is going to be extremely long on the Maker token. And so he wants to provide liquidity with Maker, but he doesn't want to sell any of it in order to fund the other side of the pool. So on Bancor, the protocol itself will create the token in order to support Tony's liquidity provision. And then both of these characters are entering into a sort of business agreement with each other, that they are both providing 50% of the pool. And so they're going to share in 50% of the profits, and also potentially 50% of the impermanent loss. But we're going to address the impermanent loss part slightly later in the presentation. So after Tony has provided that liquidity, a Bancor enthusiast, in this case personified by Martin from The Simpsons, he can come along and then decide that the Maker pool is highly performant, it's maybe earning some good fees. And so when Martin provides his BNT token, the protocol withdraws the token that it minted to support Tony. Martin's token goes into the pool, and then the protocol's tokens are burned in that process. What's interesting is that depending on when the protocol is doing this, this can actually be a deflationary event. So if it's just burning all of the tokens that it minted in the first place, then this is a zero-sum game. However, if there's been some trading on the pool leading up to this point, then it's actually possible that the pool tokens are worth more at this point. And when the BNT tokens are burned during this process, then some of the BNT that had been absorbed out of the secondary market actually gets stuck onto this supply and gets burned in the process. So this is one of the ways that the protocol can contract the token supply when it needs to. The other thing that the elastic supply allows Bancor to achieve is impermanent loss insurance. And this is really important, we think, because we're trying to target a demographic here of people that want to passively earn an income on the tokens that they have, something like a high interest bank account or something to that effect, and don't want to sort of actively manage their risk. So let's come back to the example where Tony is providing Maker tokens and the protocol is providing BNT tokens. The same setup occurs as before. They both contribute each token to the pool. And we're now going to think of the two things that can happen. One is that the price of BNT during the time that the liquidity pool is established rises relative to Maker. And for the sake of this demonstration, we're just going to forget about trading fees. However, this is obviously a gross oversimplification. We can talk about how trading fees affect this in just a couple of slides. So if the price of BNT is rising relative to Maker, then arbitrageurs are going to be depositing more Maker into the pool and removing BNT in the process via a token swap. And so at the end of this process, when Tony decides to withdraw his liquidity, the protocol will own some of that maker supply. And so when it liquidates its pool tokens in order to release Tony's funds back to him, it will burn some of the BNT pool tokens that it had and release the maker tokens to Tony. So Tony didn't have to wear this impermanent loss himself. The protocol essentially took some of the impermanent loss hit, which allows Tony to enjoy full long exposure on maker without having to take exposure to BNT. In the case where the BNT price is going down, the opposite happens. So arbitrageurs are going to be extracting maker from the pool and depositing more BNT into the pool. And so in this case, there won't actually be enough maker tokens to provide Tony back all of the maker tokens that he provided, but there's still a lot of value in the pool. There's going to be slightly less than there was if we're considering a situation where there's no trading and so no fees. But for the sake of this hypothetical, how the protocol would reimburse Tony for his loss is it can still mint more BNT tokens. And so it can calculate exactly what Tony's loss was and whatever trading fees he should be entitled to. And then it gives all of that value back to Tony at the time that he withdraws. Tony then has slightly less maker tokens in this particular example, but he's got the same value that he would have had in maker tokens substituted by BNT. And because BNT is such a highly liquid resource and it's accepted on all major exchanges, it's very easy for Tony to trade those BNTs to get back the maker tokens that he wanted. It's possible that we can automate something like this in the future, but at the moment, this part is still manual. So what Tony has effectively
Mark, can we I have one little question, or maybe people have more questions. I was wondering if BNT is going down and then potentially Bancor is minting more tokens to subsidize this impermanent loss. Wouldn't that create like a spiral in which BNT keeps going down and then you need to mint even more? And wouldn't that be the
absolutely. So that was certainly one of the gambits, I think, with the launch of the protocol. But we have other deflationary mechanisms in place that we can finally control and sort of react to changing market conditions. One is the Vortex, and I'm going to explain that in just a few moments. But what I should point out is that since V2.1 has launched, the price of BNT has gone something like 20x, not quite 20x. And that means that the protocol is now extremely well hedged, right? It has hundreds of millions of dollars in linked tokens, in USD, stablecoins, in Ethereum, wrapped Bitcoin. So at the moment, the protocol is very much in the position where it can cover all of the impermanent loss of token liquidity providers in the token that they provided. So there is no situation right now where if a maker liquidity provider, for example, withdrew their liquidity, that they wouldn't receive everything back in maker tokens. So that's really good. If we had the opposite situation where after we launched V2.1, the price of BNT underperformed the rest of the market, that would have been a slightly different situation. But there's another safety net that we have, and that is the amount of BNT locked inside the protocol actually limits how far the price of BNT can depreciate. And if I can ask for your patience, I actually have slides prepared for this. We're just not at there right now. But does my answer satisfy you, at least for the time being?
Yeah, totally. Sorry about the impatience. Just skipping ahead.
No, that's okay. Feel free to interrupt me all the way through it. But yeah, once we get back up to.
I was wondering if there are any other questions, but if not, we can keep going.
Yeah, I mean, we can return to these questions at the end of the presentation if you like. I feel like once we get through all of the slides, there's going to be like a lot of stuff will be answered on the way. But if there's something that you feel like wasn't satisfactorily covered, I can easily engage you in further discussion. Okay, so what we need to appreciate about Tony's position here is that he has effectively bought from the protocol by providing liquidity an American perpetual option. It's an American option in the sense that it can be claimed at any point before its maturity, and it's a perpetual option because it has no expiry date. When we are evaluating the value, right, of that option, we only need to consider how much impermanent loss Tony has suffered, because that's the value that he's getting back from the protocol, right? This is the cost to the protocol. And there's a fairly easy way to calculate that. In this case, P is the price of the token when he's choosing to withdraw it, and P0 is the price when he deposited it. And so we're not going to get into the derivation of this, but this is the impermanent loss calculation that shows how much value Tony is getting out of the protocol as a result of the impermanent loss insurance. What you should appreciate about that expression there is that the value of that option is increasing as the square root of time. Up until now, we have been ignoring fees, and we're going to introduce it here now. And that is that fees don't grow as the square root of time, they grow in linear time. So if we reverse this situation and look at it from the protocol's perspective, the value that the protocol is losing is growing in the square root of time. But the fees, because it's sharing the fees with Tony, that's also growing in linear time. So you can run various models on this to see where the break-even point is before the fees earned by the protocol actually overshoot the impermanent loss liability. And this is going to be different for every pool, because certain trading pairs have higher volumes than others. Different market effects, volatility will affect the profitability of a pool. But because the BNT supply is always at the center of this calculation, it's fair to take sort of an aggregate across the entire protocol in order to evaluate whether or not this risk is being properly addressed. And so over the time that we've been doing this, liquidity providers have withdrawn about $20 billion or something in liquidity. And during that time, we've only had to mint about 2 million BNT tokens to cover impermanent loss. So, for a new protocol that's still struggling to get the sort of volume that Uniswap and such is getting, we're actually doing very, very well. And the method, the economics behind it have proved to be sound. Although I would be the first to concede we were a little bit optimistic at the time that we launched. But luckily, we've already had a situation where BNT has gone 20x, where the rest of the market was relatively quiet, and the overall liability of the protocol has been pretty mild. This is probably a good time to say that this isn't bribery in any way, but the Bancor DAO has just recently voted to activate liquidity mining rewards on Maker. And so this vote was live yesterday. It's actually still occurring, and it looks very much like it's going to pass. We've got an 87% in favor of activating liquidity mining on Maker, and we've already achieved a 43% quorum. And so this is a program where we're trying to incentivize certain pools that we're interested in growing, and Maker is one of these pools. And so this means that if you provide Maker tokens, not only are you earning swap fees in Maker tokens itself, but the inflationary policy of Bancor is also going to reward you with BNT tokens as well. Okay, the next part that we need to discuss is something called the Bancor Vortex. And this comes back to some of this deflationary policy that we were discussing earlier. So when a BNT liquidity provider provides liquidity, it's slightly different from the token side. When they stake it into the pool, they actually receive a voting token in return. And this is VBNT. The VBNT is usually staked in the Ethereum governance contract and is used to vote on proposals such as the activation of liquidity mining rewards on Maker that we just saw earlier. Our governance used to be entirely on chain, but we have since moved to Snapshot, and this has helped to boost governance participation. As you saw before, we've already achieved something like a 40% quorum, which is pretty good for a system that has now many thousands of different BBNT holders. We have recently launched a product called the Bancor Vortex, which transforms VBNT into a type of leverage token. And so I can demonstrate briefly how this works. We have a VBNT pool, and so that allows the VBNT to be swapped directly for BNT, and then that BNT can be swapped in a second hop for any other asset on the network, something like Ethereum. And then that Ethereum is returned to the BNT liquidity provider. Let's just run through this quickly because something interesting happened here that I think is easy to miss. Let's say that you start with $100 in BNT. By the end of this process, you still have your $100 of BNT staked in the contract, but you have received $100 in Ethereum during this two-hop swap process. So at the start, you've got $100, and at the end of this process, it seems like you have $200, which can't make sense, right? You can't make money from nothing. And so the important thing to realize here is that the $100 of BNT that has been staked, it cannot be unstaked without a key. And that key is the VBNT token, right? The voting token. When you unstake your BNT from the Bancor protocol, you have to sacrifice, you have to relinquish your voting rights. And so being able to use VBNT as a leverage token is essentially saying that if you sell off that VBNT, if you ever want to come back for the staked BNT, you have to purchase it back again. In this particular instance, the VBNT has been sold for Ethereum, and so he's completely unable to access that staked BNT. And so the BNT is kind of serving like a collateral system against the Ethereum that he's taken away from the protocol. So the BNT remains locked in the contract until he comes back for it. When he comes back for it, it's a relatively simple process just to reverse those steps. The Ethereum can be swapped back for BNT, and then the BNT can be traded back for VBNT. And then with that VBNT, that's the key to the lock. And you can unlock the stake BNT and remove yourself from the protocol. And so we're calling this a leveraged liquidity system. But what's interesting about it is that there's it replaces things like insurance rates and interest rates and margin calls with a simple bonding curve mechanic that helps to limit how much leverage is actually available. So consider the situation where we start the VBNT-BNT pool at a 1-to-1 rate. So this means that the price of VBNT is equal to the price of BNT. As liquidity providers enter into leverage, that's actually going to force the price of VBNT down relative to BNT, and that makes it less desirable to enter into a leveraged position. Essentially, the risk of leveraging goes up as the price of VBNT comes down. And this is where the protocol comes back in and introduces the deflationary part of the Bancor Vortex. A small amount of swap revenue from the protocol at the moment, it's 5%, so it's negligible really from the liquidity provider's point of view, is used to purchase VBNT back from that VBNT-BNT pool and burn it. So this means that VBNT is constantly leaving the system, right? Is never coming back, and some of the BNT that is staked in the protocol can never be unstaked. As that burning takes place, this pushes the price of VBNT back up and means that the risk to entering leveraging starts to come back. And so this helps to sort of create an equilibrium price that kind of manages the debt limit over time. It's possible, unlikely, but still possible, that during extremely performant periods in the protocol's future, that it might actually burn VBNT at such a rate that it overshoots the peg and the price of VBNT becomes worth more than a single BNT does. And this opens up a potential arbitrage opportunity for someone like Mr. Burns. So let's say that the price of VBNT rises 10% above BNT. You now have an incentive to buy BNT on the open market, stake it in any pool that you want, say the Ethereum pool, and then sell the VBNT that you get immediately for a 10% profit. That BNT can then be sold for whatever asset you want on the network, and you can take that away with you. So in this case, our arbitrager, represented by Mr. Burns, he started with $100 of BNT and was able to swap that for $110 worth of ETH via this arbitrage situation that he noticed. What's interesting though is that he may not ever have an incentive to come back for that BNT. He's already made his profit. And so that BNT that he staked in the network is probably going to be locked forever. when he does this, he's only incentivized to do it until the price is back to 1-to-1. So the effect of this is that $100 in BNT that he's staked to perform arbitrage is likely to be locked in the protocol forever, and this drives the total value locked of the network up over time. And so this is entirely fueled by swap fees on the network and by the risk management or lack thereof of liquidity providers entering into leverage. So the reason why we're talking about TVL of the network from in a maker onboarding call is that this actually turns BNT into a pretty reliable collateral. And I'm very happy to explain why this is the case. So at the moment, we have a very large number of different tokens on the protocol, and all of them are paired with BNT. So I think at the time of this presentation, we've got about $1.7 billion in liquidity, and half of that is in BNT tokens. And each one of those BNT tokens is then, is in a bonding curve environment with the tokens that liquidity providers have provided. This has an interesting effect of turning BNT into something like an index token. So if you consider the three deepest pools on our network, which is Chainlink, Ethereum, and wrapped Bitcoin, which have about 350 to $400 million worth of liquidity each, as the price of, for example, Bitcoin is changing, right? Let's say the price of Bitcoin is rising, then an arbitrageur will buy that wrapped Bitcoin off the pool by buying BNT off the open market and then swapping it on that pool for the wrapped Bitcoin. So as the price of wrapped Bitcoin goes up, it actually drags the price of BNT with it a little bit. The same is true of Chainlink and Ethereum. So we have a very highly correlated price now with these three assets, or at least some aggregate version of them. And that makes it, I think that gives an interesting value to BNT, because if the price was ever to try and crash, the protocol would actually just buy it back. And we're about to discuss that right now, actually. So at the time of this presentation, the total supply locked of BNT is about 69.8%. That's quite a huge number, right? If you think about how many BNTs there are now in circulation. So that means that there's about 30.21% that aren't in circulation. That 30% is essentially all that the markets have to try and move the price of BNT with. What's interesting is, like, as any short seller will be able to tell you, is that the price in the down direction is limited, but the price in the up direction is unlimited. So let's consider this case, right, where we go to an order book based, secondary market maker like Binance, for example, and then there's a lot of selling pressure happening there. As the price of BNT drops on those secondary markets, the arbitrageurs that help balance our pools will keep buying it from those markets and then selling it back on the BNT pools. And so this actually has the effect of forcing the supply that's locked in the protocol up over time. And so as the price continues to drop on Binance, the supply locked in the protocol just continues to go up. And so you don't have to be a rocket scientist to see that eventually you will run out of BNT to sell on the secondary markets. And this gives BNT an effective floor price that is determined by its TVL. So as long as the TVL of BNT inside the network remains high, there's actually a maximum price floor that's possible to achieve if every single BNT on the secondary market was all sold at once, which is a really nice safety net to have, I think, for a collateral asset. By the way, this is a symmetric effect. Just how it's now difficult to push the price of BNT down, it also requires more demand pressure to force the BNT price up. So just like when I was explaining with Tony and the maker tokens, when the BNT price is going up, arbitrageurs are buying it off the pool and introducing it back into secondary markets by depositing the other token on the other side. And so for a while, I was curious as to how much of an effect this would actually have on BNT price action. But just recently, we've seen that it's still possible to get that really nice upwards volatility. And so I think we started this recent rally with a 68% locked BNT supply. And so as the price was rallying up this curve, the locked supply was coming down. But we're now back to that same value, which has this interesting effect of kind of ratcheting the BNT price up a ladder. So as long as the BNT keeps coming back and being restaked, we effectively form a new price floor that just can't be broken through on the downside. This, by the way, is happening with really extreme trading volumes. So you wouldn't know it from looking at the price charts, because BNT now has this, it's kind of a joke in DeFi that Bancor at any time is like a new stable coin. But actually on secondary markets, the volume is going completely wild. So the 24-hour volume on Binance, for example, in the hours leading up to this presentation is a little over $80 billion. So it's not like it's not being traded. The volume is absolutely huge, but the actual price volatility resulting from that volume is quite small now. The other thing that I think BNT, I meant to make a point on this slide, and that is that I think having an asset that has a characteristic non-volatility is a really good, that's a characteristic that you should value in a collateral asset, right? This is something that is not going to suddenly drop through the floor and cause, liquidation lags or something like that, such as what happened to the Maker protocol back in March in 2020. Having something like BNT, you've got this predictability to its actual price volatility, and that gives trading bots or whatever time to react and liquidate users' loans if it has to. The other thing that I think that Bancor really brings to the table in terms of, I see this as a kind of DeFi collaboration. And that there is a function that Bancor has that makes integrating with Maker extremely easy. So let's just remind ourselves, because this is a community call and I'm not sure how familiar everyone is with the Maker system. But Maker provides permissionless loans. And so we're going to use Amy Wong from Futurama as our BNT enthusiast. And she's got some BNT and she wants to provide that as collateral. So she provides that to Maker. Maker provides her with a DAI stable token, and then she takes that away with her. So now we're going to assume that something has gone wrong. She didn't repay her loan, and there's going to be a liquidation event happening on that particular loan. The fact that BNT is so well distributed on major exchanges, and the fact that it has this relative non-volatility, also means that the Oracle reliability of this particular margin call is likely to be highly trustworthy. Okay, so now someone is going to come and trigger this liquidation event, and I'm going to use Bean from Disenchantment. So she has now the responsibility of taking this BNT collateral and trying to swap it back for DAI in order to repay the loan. This is what I think Bancor really brings to the table, and that is that it has a pool for DAI that is already $68 million deep. And so that collateral is directly exchangeable on-chain for DAI at the time that the liquidation happens. It could be the very next block. So taking the collateral and then exchanging it back for the DAI required to repay the loan is really, really easy. Bean will then, I think this is how it works, is that she gets to keep some of the collateral that is not required to repay the loan, and then the rest of it goes back into the Maker protocol. So I see this as being actually a really natural way for collateralized assets to be exchanged back for the loaned asset. And we didn't know that we were doing it, right? It's not like we built the DAI pool specifically for this purpose. It was because stablecoins and DAI being one of the most important stablecoins, our ecosystem already required it. But now that it's here, it's like we already have built the infrastructure required to support a maker collateralized system. And I think that it would be, it would be silly to not take advantage of that synergy. The other thing that I want to point out is that this number is still low. We've actually deliberately capped some of the stable coins at relatively small amounts. If you consider $68 million to be a small amount. But the problem is that because DAI has a stable price, the impermanent loss relative to something like BNT, which is climbing quite quickly, is pretty high. And so this becomes a bit of a tax on our system. If you remember that we spoke about the fact that Chainlink, Ethereum, and wrapped Bitcoin are kind of all pulling on each other's price now via BNT. The same is true of the stable tokens. And so they kind of anchor the BNT price down a little bit. And so we've got sort of a disincentive to make these pools particularly deep. But one of the things that I've been working on is a way to overcome this issue. Like, how do you have very deep stablecoin liquidity without exposing the protocol to huge impermanent loss liability? And the product that I'm developing, that I'm researching, that's about to enter into the development stages, I think that we should be able to add a 0 to the end of this and have extremely deep stablecoin liquidity. This is important for Bancor in terms of competing with other AMMs, especially places like Curve that have a huge market appeal because of their stablecoin liquidity. And Bancor is interested in not necessarily competing with them, but offering a similar service. And as that product gets up and running, it's only going to make swapping the BNT collateral back for DAI to repay the loan easier over time. The slippage is just going to keep coming down. Okay, so that is the end of, I guess, what is a pitch, I suppose, to why I think BNT should be accepted as collateral on Maker. But also, I hope you learned a little bit about the Bancor protocol, and I'd be very interested to answer any and all questions that any of the listeners have. But if anyone wants to dig into the Bancor protocol, tokenomics, and economic and quantitative financial analysis a little bit more thoroughly, we actually do have an effective white paper, an economic white paper out on this, and it can be accessed online if you just Google this title. But yeah, thank you for listening, and be very happy to accept questions now.
Right. Thank you, Mark. So the floor is open for questions. Are we shy today? Frank, you always have a question.
Who was it that asked me before about the death spiral of BNT? Are you still on the call?
Yeah, I think it was me, no?
Yeah, it was you. It was Juan.
Yeah, so I was wondering how you kind of dealt with that. I mean, it's a lot of very interesting concepts. I think I need to sit down and start trying to poke holes in the theory until I realize that probably people much smarter than me build it. But yeah, that's how I try to understand it. I was wondering, I don't know, Mark, if you have an answer, but usually our risk team has to do an evaluation and propose what we call the debt ceiling, which is like the maximum amount of DAI that can be minted out of a specific token for any kind of given reasons. I don't know if you guys, well, I don't want to call it a wish, right? Because it doesn't work that way. But would you propose any figure, or is there any number that you're envisioning to start? Yeah.
I don't have necessarily an ambition to start at any number. But I think that the best way to inform that decision is to look at our DAI BNT liquidity depth, right? Because what you're really hoping to be able to do is to, during a liquidation event, to be able to swap as much of that Bancor back as possible for the correct amount of DAI. And so you can just look at the depth of the DAI pool, and then set up a an acceptable amount of slippage. And that would actually just give you the exact amount of DAI that's possible to be loaned at any time. So I think if you wanted to approach it in an objective way, that would be a good way to go about it. But I wouldn't hope to recommend what an acceptable slippage is. I think that's something for the risk assessors at Maker to take care of. But I do think that, compared to other tokens, it is something that has a very direct, calculable answer.
Maybe I understood, Juan. Were you asking the maximum BNT could be minted? Is that what you were asking?
No, the maximum DAI that can be minted.
Got it. Is that
yeah,
right?
So
Okay.
I don't know if the keepers is the participants that do the take care of the auctions, right? So that's definitely one of the metrics that the risk team is looking, but also I don't know, usability. That's also how we prioritize different tokens and how we onboard them. And there are different factors. But yeah, you're right that how fast you can cycle the asset for a potential liquidation is quite important for the risk part. But also the part of I guess the use case is it's quite interesting. Do you think that any user that's going through this process is mainly to use leverage on their positions, or is it some other use case that you're envisioning?
Yeah, so I think that with any loan system, be it Maker or Aave or whatever, even a pawnbroker, right, where they accept jewelry or something for cash, there are going to be times where people would rather not sell their Bancor because they're expecting that the price is going to appreciate over time. But for whatever reason, they need to access some of that value.
Right.
So at the moment, as I pointed out with the Vortex system the system that we have enabled that gives users some of that capability, it's not the same because it's not a stable loan, right? You enter into a speculative debt position, and there are people speculating on the other side of that transaction that can make it very difficult to evaluate the risk. So if you're selling, for example, BBNT to try and get DAI, which is something that you can do on the Bancor protocol right now, it's not clear how much you're going to have to repay, right? Because the price of BNT can change, the price of BBNT can change. And so for a lot of people, that's an unacceptable risk that they simply won't take. We have, I think what Maker offers, and what I think a lot of Bancor holders would like, is the ability to borrow a stable loan. I think the advantage of borrowing something like DAI is you always know exactly how much you have to pay back, and just as Ether is accepted by as collateral by Maker, whatever is motivating the Ether holders to take a loan is the same thing that is going to be motivating BNT holders to take a loan.
Right, sounds good. Are there any other questions, guys, or should I keep shooting?
I was curious if you knew how many other protocols or platforms had integrated BNT already in terms of borrowing or lending.
So Maker is our priority. So this would be the first, but we have also spoken with the Aave team recently, and we're trying to get we will be preparing the proposal for their risk assessors to accept BNT on Aave shortly. In both of these cases, by the way, it actually makes a lot more sense in terms of the DeFi Lego structure to eventually get BBNT listed as collateral on both of these platforms. The problem is that BBNT is it's not very liquid right now. I think Bancor network has something like $3 million in liquidity for it, which isn't very much, and it's essentially one of the only places that you can buy it. I think there's another source of liquidity on Balancer, but not as deep. And yeah, so as a, you know, from the Bancor network's perspective, that would be a much more exciting prospect, right? To get VBNT listed, because it means that you can have your Bancor tokens earning yield and then borrow against your VBNT to participate in other stuff, knowing exactly what you have to pay back. But until we get the token healthy and properly distributed and accepted on major exchanges and stuff, we're not really considering that. But yeah, so the short answer to your question is Maker would be the first to accept BNT, but I think that Aave will be close behind it. However, I should say
Frank
that Swiss.
oh, sorry.
I was going to say that in terms of lending services, in DeFi, Maker would be the first. And I have to look into exactly how this is set up. But one of the major Swiss banks now will let users deposit and hold BNT in their account.
Nice. So Frank writes in the chat, in a bear market, what would be an approximate yield for DAI, assuming it would drift downwards? Also, does Bancor support dual-sided liquidity for pools with rewards?
Okay, so what was the first question?
In a bear market, what would be an approximate yield for DAI, assuming it would drift downwards?
Assuming what would drift downwards? BNT, I suppose.
I think so, yes.
Yeah, so I mean, we can run a couple of simulations on this, but it really depends on what the over collateralization is and how fast the market's changing. But yeah, and we also don't know necessarily what the risk assessors at Maker are going to decide is going to be an acceptable risk profile for minting DAI. So there's too many unknowns, I think, to answer that question specifically. But I think that you could see Bancor as being comparable to some of the other assets that have been accepted in the multi-collateral system. For the second question, which was, what was that? What was that one? Okay, does Bancor support
dual-sided liquidity?
Dual-sided liquidity. The short answer is no. The way that the front end works, the short answer is no. If you are referring to the parts of the network that offer impermanent loss protection and single-sided exposure. We also have, like, Bancor is still a decentralized, it's still a decentralized service, and so there is a permissionless way to set up your own pools for whatever tokens you want, and you don't have to wait for the DAO or anyone else to whitelist it for you. And in that case, you do supply both sides of the pool yourself as a liquidity provider, and you would be issued the same types of pool tokens that you get on Uniswap and SushiSwap. So yeah, we still do have the dual-sided liquidity pools, but the insurance contracts on the whitelisted pools that support single-sided exposure and impermanent loss insurance, those you can just you are required to deposit single-sided.
Great. Question a bit more maybe technical for the smart contracts team. Is BNT like a standard token, or a standard ERC20, I guess, or is it upgradable? Is there anything that they should look for?
No, so yeah, BNT is 100% ERC20 compliant. As far as Asaf, are you still on the call?
Yes, I'm right here.
I think Yudi is on the call.
Yudi, I didn't know he was here. But the contract, right? It's deployed in immutable form.
Yeah, the contract is not upgradable. It exposes a few special functions, but these are also restricted. So pretty standard, yeah.
Okay, sounds good.
There's no way, for example, to burn tokens from users or from holders or something.
Sounds good. Any other questions from the community? You guys have been particularly shy today.
Yeah, I mean, I know Maker we're exploring kind of optimism and other layer 2 solutions. Was curious if you guys on your end have been looking into any of that in terms of helping with the gas fees.
Yeah, of course we are. I think, it has yet to be determined what the effect of layer 2 is going to be on Ethereum and on DeFi in general. I would say that there are two major camps. And actually that's not even true. There's a full spectrum. But at one end of the spectrum is that, layer 2 is the godsend that Ethereum's been waiting for, and it kind of fixes all of Ethereum's problems. And then on the other end of the spectrum is that layer 2 is just another side chain. And moving to some of these scaling solutions is akin to moving to BSC or moving to Polkadot or whatever. I would say that I'm somewhere in between that. I think that layer 2 will have a really important role in the future of Ethereum. But that layer 1, I think, will still be the commanding main, main service provider, main support infrastructure for services on Ethereum. As a DEX, it's difficult to know exactly which way to go, because as you point out, the gas fees are exorbitantly, are getting prohibitively high on Ethereum. And so moving to layer 2 to get the gas fees down is certainly tempting and it's very valuable. In terms of user sentiment, I think that we could even attract a lot more volume potentially on a layer 2. However, we also rely on activity like arbitrageurs, for example, that need to rebalance the pools, and a bunch of other things that it's not clear how well some of those functions will continue to operate if they're having to constantly transition between layer 1 and layer 2. I think that with things like optimism, for example, I think there's like a 6-day wait time, I think, to change layers. And I can see that as causing some pretty unavoidable problems, and it may even lead to some dysfunction, as a DEX. It doesn't mean that we're not interested in going there. You may know that we've already got a deployment on the Arbitrum testnet, and we find the finality, I think, of Arbitrum extremely attractive. But it's still uncertain as to how many users will actually go there. But if it becomes popular and there's a lot of users up there and the infrastructure improves and it looks like it's a popular place to be, Bancor is extremely blockchain agnostic, and so we will go there. Similar to our bridge on Moonbeam on Polkadot. If the Polkadot ecosystem starts to become really popular and gets a lot of traction, we'll go there as well.
Mark, I was going back a little bit to the market. If I remember correctly, you said that there was 1.7 billion TVL in the.
Yeah, I think so.
So that divided by. So that divided by 2 would be the amount of tokens that are BNT in total, right?
The total value of BNT, correct?
Yeah, so that would be 850 million. And you said that around 30%
Correct.
was kind of like free, so that's 255 million. I was trying to size the market, like if we, and I know that it's kind of like a, if we do onboard this collateral type, it would help to generate more, right? But I don't know if 10% of that market join it, it'll be potentially 25 million.
Yeah, I think that that's a sensible way to go about it. One of the difficulties in evaluating BNT's market size is that the elasticity of the token itself means that it can get a bit tricky. We've just recently, the economics team has found a way to calculate a more accurate figure for what the true circulating supply of BNT is.
Mm-hmm.
But from the maker perspective, honestly, just looking at the protocol itself and what its total liquidity is and dividing that by 2 is actually, I think, the most sensible way to go about it. That an investor, for example, would come to a different conclusion because they're more interested in, you know, appreciation and capitalization, which is not necessarily the main motivating factors for collateral asset risk.
Totally. Okay, we're reaching almost the top of the hour. So where can people learn more about Bancor and potentially reach you?
Yeah, so I'm actually active on the Maker forum. I think that my my username was included with the with this onboarding call. It's actually strange. Like, so Maker was the first DAO that I ever became involved in, right? It was the first forum that I joined and tried to learn about how DAOs operate, and that was long before I was a part of Bancor. So yeah, you can reach me there if you like. I still check that forum regularly. I like to see what Maker is up to. I really admire how the DAO operates and organizes itself. So if you message me there, I will find it. But otherwise, you can always reach out to me on Telegram or on Twitter. I check those almost every day. And I think, yeah, or you can also email me, which is my name, mark@bancor.network. And I'll be happy to respond to you via email as well.
Sounds good.
I'm not sure, is it possible for me can I write something so that people can copy my details down?
Yeah, I was hoping for a slide after such an amazing deck.
Oh yeah, you know what? Crap, I should have done that. I should have done that, man. There's always something I forget. Yeah, I'll put it in the chat.
I mean, people are most likely seeing this in the forum. We'll upload the video once it's on YouTube. So it's forum.makerdao.com. So you can find there Mark Richardson, or just look for Bancor there.
We'll add a closing card to the video or something to make up for the lack of sure. Contact information.
And Nate posted some. He threw some links on the chat. We'll try to get them there as well. All right. So thank you, Mark, Asaf, Yudi, Nate. Hopefully, I'm not forgetting anyone from the team. Thanks for coming and presenting. And yeah, let's keep in touch.
Awesome. Thanks so much.
Great. Thank you.
Nice one, guys.
Appreciate it.
Bye-bye.
Thank you.